Well, there are expectations that India would get included in the global bond indices by early 2022, and Morgan Stanley projects the index inclusion will attract $170 to $250 billion in terms of bond inflows in the next decade in their base case and bull case scenario. In fact, they state that this would have profound implications for the India economy, forex markets, bond yields, as well as in terms of the equity markets. Morgan Stanley states that this is certainly a positive move, and there has been significant shift in terms of the context that India has shown good amount of improvement in terms of the overall macro stability, and the government wants to push growth, which would be capex-driven growth. They state that the inclusion would, they are rather expecting one-off index inflows of $40 billion in 22-23, followed by annual inflows of $18.5 billion in the next decade, pushing foreign ownership by up to 9% by 2031. In terms of economic implications, Morgan Stanley states that the opening up indicates policymakers' desire to push for growth rates higher through investment. It will push India's balance of payments into a structurally surplus zone, indirectly creating an environment for lower cost of capital, and ultimately it would be positive for growth. In fact, a structural surplus in the balance of payments and improved productivity could drive the rupee to appreciate by 2% per year in real terms. In terms of sovereign credit implications, Morgan Stanley states that foreign inflows should lead to lower borrowing cost, which helps debt sustainability, as it is important for India to keep an investment grade rating. They're stating that given the current historically low FPI utilization rate, the India's onshore corporate bond market had become a forgotten attractive opportunity for foreign investors. Hence, they are expecting foreign inflows to pick up in the medium to long term thanks to better liquidity and higher yields. In terms of equity implications, Morgan Stanley states that the opening up of the sovereign bond market and resultant inflows should definitely bring good news for the Indian equity returns. It will have positive implications on growth and likely implications for softening of interest rates, and they believe this accentuates the case for India's return correlations to decline. In terms of stock implications, Morgan Stanley states that banks should definitely be benefiting from stronger growth and lower borrowing costs, especially the large private banks should be the key beneficiaries. And within the NBFCs, they see HDFC Limited, Bajaj Finance, SBI Cards, Mahindra Finance, as well as Cholamandalam Finance to be the key beneficiaries. So yes, watch out for this move wherein in 2022 of India getting included in the global bond index.